Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
Gene Trowbridge and Jonathan Ney, founding partners of the top syndication firm, Trowbridge Law Group, LLP, have a legal team with over 50 years of combined experience in real estate syndication and the practice of real estate securities law. Over this time, Gene and his partners in several past firms and currently have helped clients raise close to $5 billion in offerings by empowering entrepreneurs to raise capital legally. To learn more about Trowbridge Law Group, LLP, visit their website at trowbridgelawgroup.com or follow them on Facebook, Instagram, or Twitter. This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today our guest is Brian Adams. Thanks for being on the show again, Brian.
Yeah, thanks for having me.
I'm honored to have you back, and we had a great show yesterday, and I hope that the listeners listen to yesterday's show, and they're going to get to, just hear all the value that you provided. I'm still just remembering and thinking about numerous things that you said, just about investor relations and what's important to them, and understanding your marketing to them, and what that did for you and when you changed, just how you thought about those conversations, but what's important to investors. So as a listener, if you didn't listen to yesterday's show, I encourage you to go back and listen to that. Brian just provided so much valuable content, and he's just has so much experience in this industry and has done so well. I'm just looking forward to this conversation today, and just really about what's happening, what he expects to happen in the future moving forward, and what's happening with just millennial patterns and the effects of COVID. So just looking forward to getting his take on just from his experience. But a little about Brian. I won't read everything I did yesterday, but a little about Brian. He's a president and founder of Excelsior Capital, where he spearheads the investor relations and capital markets arm of the firm. He's got 10 years in real estate private equity, and he's just very well known in the space and doing some very big things. So, Brian, thank you again. But let's jump right in, and let's just get us started on what maybe some of your thoughts and things we should be thinking about that maybe you see other people that aren't thinking about those things and don't see that what's happening.
Sure. So I think the object of the conversation is talk about kind of millennial demographic shifts, patterns, and how COVID is impacting all of that. And it's a little bit cliche and hackneyed, but I think it is accurate that COVID is acting as an accelerant to pre-existing trends and conditions, right? So what we saw pre-COVID was increasingly millennials, because of 2008, they had delayed their typical family formation phase, roughly 5 years. And so there was a narrative on Wall Street that this millennial working generation, which is now the largest cohort in America, it's around 75 million people total, was always going to live in Brooklyn, wear skinny jeans, eat avocado toast, never have children, live in an apartment forever, right? That was kind of the image that we were all sold. But the reality is that as they've delayed that family formation, it is now happening where they are getting married, having children, and they are increasingly making choices about where they want to live, work, and play based on quality of life, cost of living, access to single family homes. And that doesn't mean purchasing. It just means the ability to own or rent, which I think is an important distinction. Access to education options for their children. And increasingly, because of COVID, just more space in general. And actually, I think this is where the single family home world and the commercial real estate world really parallel one another. Is increasingly this millennial generation, because of COVID, just needs more space, right? They want to get away from that density and that really urban environment. And they're looking towards, suburbs and secondary markets really check a lot of these boxes. And for many of us, I feel like every generation goes through this. My parents are the hippie generation, and they, pushed back against their parents' lifestyle and said they would never live that way. I know as a millennial, I barely qualify, but I do qualify. Back in the 2000s, we were never going to live in the suburbs and drive an SUV and send our kids to the same schools that we went to. But like most generations in the past, we we yearn for that same type of upbringing that we had for our own children. And so increasingly we're seeing this boomerang effect where, either one spouse or the other is moving back to where they grew up or within that same neighborhood because they want the same opportunities that they had growing up for their own children. And so COVID is really accelerating this trend that we saw happening over the last 5 years. And now you're seeing a lot of headlines about people fleeing New York, people fleeing California, and moving to more tax-friendly and business-friendly environments and communities.
Has this changed the, say, markets that you're focused on, or your group's focused on, or where you are spending your time?
It has. I mean, we continually reevaluate, and it's interesting because you see a lot of headlines about, Tennessee, Florida, and Texas as being the havens for these tax refugees that are leaving LA and San Francisco and New York. And they are great jurisdictions, right? They're great places to go for a whole host of reasons. But because of that huge influx of population, you're actually seeing pricing get really competitive. And so oftentimes, what was affordable for a family over the last 2 or 3 years, I know places like Nashville where I live, it really is no longer an affordable place. And so we take a look at kind of cost of living, population growth, wage growth, employment growth, and we put that all together, and we have a little bit of a risk-adjusted response or matrix that we use to find new markets. And sometimes they're not always in those 3 states. And so we're very cognizant of the fact that, this influx of capital coming out of California, New York specifically, it is good for those markets, but it also alienates a large portion of this workforce that simply can't afford to go to Austin and pay those exorbitant prices. And so we take all that into account as part of a larger trend. And I think this is one of the beautiful things about real estate, private equity, is we had to look at things at a 10-year basis, right? Mm-hmm. So what might make sense in the near term, we have to temper that with realistic expectations over the long term, and how do we create kind of long-term value, have the assets stay stabilized, and be able to continue to put out those distributions. So, we're constantly evaluating new markets. Nashville's been too expensive for us to transact over the last 3 or 4 years, and I don't see that changing anytime soon. So we're always looking for kind of value in new markets and new opportunities that we find.
So you can count on within a 10-year period, you're going to be, say, changing your focus from maybe a current market to a different market.
Yeah, I mean, I'd say that we have a matrix of probably 12 markets that we track, and we readjust it every quarter based on new economic data. And typically 1 or 2 drop out and 1 or 2 add in. And it doesn't mean we're necessarily going to transact in those places, but it does. I think it's a good practice to have that type of discipline, because we've rotated out of Nashville, we've rotated out of Tampa, we've rotated out of Raleigh. And it doesn't mean those markets aren't great today, but what I'm trying to achieve is consistent cash flow. And what I've found during the course of my 10-year career is when you purchase that building, even though you think it's an attractive deal day one, and that you'll grow into that on a cap rate basis, maybe the basis that you buy that at, right? The per square foot, per pound cost, you will never be able to escape that basis. That basis will stay with you forever until you sell the asset. And so you've got to be really mindful on what you're paying on a per square foot basis, especially in secondary markets. So we look at things not only as a discount to replacement cost, which I think is a fine metric, but the way we like to look at things is a discount to replacement rents. What are Class A rents in the market today? And what rents would be required to justify new speculative development and construction? And so we like to have a very wide spread there to feel protected as a landlord. And that's where those markets like Austin and Nashville and Raleigh and some locations in Florida, I think the economic growth is tremendous in those places, but it doesn't mean they're not very, very expensive to transact in. And so you have to be very cautious there of playing well, we're going to refi it in 2 years and then we're going to sell it in 3 years because there's going to be this crazy cap rate compression. Maybe, but that's not the business we're in. That's not the type of risk we're taking.
Nice. No, I appreciate you explaining that. It could, and I've had a list of questions here, but since you're on that, could you speak to that risk a little bit that you see others taking on the cap rate compression that they're seeing or accounting on?
Right. And this is where, for investors, when they see a pro forma, when they see a deck and they see a big IRR on there, this is where I think you need to be very cautious, because if a sponsor or GP is buying something at a 7 cap and they're buying it for the most part fairly stable because they want that cash flow, they know the investors want that cash flow, and they're achieving an IRR that's in the high teens or even 20s plus, probably the only way they're going to get there on that short of a hold is by saying, well, I'm going to buy it at a 7 cap and I'm going to sell it at a 6 cap, because that's just the way of the world, right? We've been in this increasingly cap rate compression environment for the last cycle since '08. And if you assume that's going to happen and you can pencil in a really aggressive cap rate compression on the exit, you're going to hit a big IRR. But the issue is you have no control over what that cap rate environment is going to be upon sale, right? I mean, unless you're probably going to do variable debt, you're probably going to work with a local bank, so you don't have any kind of defeasance cost or a breakup fee if it's CMBS or Lifeco. And so you have to understand as an investor that that's the risk you're taking, because that's the game that the GP and sponsor is taking, because oftentimes these groups only make money on the buy because they charge an acquisition fee, and they only make money on the back end when they sell something and their carried interest hits. And so that's the game that some sponsors play. And you need to be really wary of that, in my opinion. My deals, we pencil in the same cap rate upon exit that we do on entrance. So if I buy something at an 8.2 cap, I'm going to model it to exit at an 8.2 cap. And unless I can hit that kind of mid to low teens IRR, then the deal doesn't make sense, in my opinion, because I have no control over where that cap rate environment is going to be. I don't know what the debt markets are going to look like. I don't know what's going to be happening on a macroeconomic scale, let alone what's happening in Kansas City or Richmond or Cincinnati. And so that's where I think sometimes investors take a risk without realizing it, because they're banking on debt becoming cheaper, cap rates going down just because they have over the last 10 years. But that's not written anywhere. That's not a given. And so that is a risk factor you're taking on the deal.
So you're going to have the same exit cap that, as your entry cap. So, where in your deal or your underwriting are you adding the value, or, where's that coming?
Yeah. So it's typically right sizing the deal to market rents, market rate, and market credit in terms of term and user profile, right? So what we typically find is, I'd say the typical fact pattern for us is buying a property that's 85 to 95% occupied. We're buying it at somewhere in that 7 to 8 cap range. And we're putting on long-term fixed debt. And you can gauge based on the fact that that's a 10-year fixed loan, what the historical occupancy and NOI has been on that asset. If you look at my cash reserves and what I'm putting aside for tenant improvement dollars and leasing commissions, after all of that in debt service, if I'm able to achieve an 8% cash on cash yield on average, that's how we're doing it. And if I can bring rents up $1.25 a square foot, improve credit quality and improve term to just what is market within that submarket, these are simplistic things. But I think oftentimes we look at value add as we're going to reskin the building, we're going to put in new HVAC, new elevators, new roof, we're going to blow out the lobby. But the problem with that is those are not necessarily day one revenue generating expenditures. And so we only like to spend money on things that are going to result in higher NOI and more cash flow to the investors. So that's why we think of things as kind of more of a stable cash flow oriented investment. And frankly, most of my investors, unless it's going to be a really big IRR or a very big multiple on invested capital, they would rather have that quarterly coupon and that income production than they would the capital back. And so it's just a different way of looking at investments for us.
Nice. No, I'm grateful for you going into that. I know a lot of the listeners are wondering the same thing, and there's tons of questions that we could talk about there. I wanted to back up just a little bit, though. We're talking about, where to find, or just talking about market data and things that you were going over, and like quarterly, you're analyzing, a specific, say, 10 or 12 markets and watching them. Where are you finding the data that you count on, that's accurate for those markets?
Yeah, I mean, anywhere and everywhere. So we are data centric, and that's where we spend a lot of our time. That's how I spend a lot of my time. And there's some great resources. If you go to just within the federal government, the Department of Labor, and some of the economic indicators that you see sent out, manufacturing index, et cetera, that's on a high level. States also typically will have economic community development or Chamber of Commerce for city-specific markets. And you can really dive into that data. And those folks are obviously in the business of trying to get corporate relocations. And so you've got to take some of it with a grain of salt, but it is a really good resource to see, okay, well, how has employment growth looked? How has wage growth looked? What are the underlying economic drivers for this market in Kansas City per se? What does the average household income look like within 5 miles of the asset? Those are the type of things that we look into. And then we're subscribed to all of the Cushmans and the JLLs and the CBRE data providers that are typical. And we can really look and see, okay, well, what are average asking rents look like over the last 10 years? And really one of the things that we dive into the most on a submarket level is how did these neighborhoods and oftentimes these specific assets, how did they behave in '08? Because that's the best stress test that we have in the modern era is what happened during '08. How did the asset perform in 2009, 2010, 2011? How did the submarket perform? And if it did well, which we say is if it didn't go above, call it a 12% vacancy rate, then that's a pretty resilient submarket in our opinion. Because if you take a step back and look at places like Atlanta today, even pre-COVID, when things were really humming, they still had submarket vacancy of 25, 30% in some neighborhoods, right? So you have to be really wary about exciting markets that are interesting, like Austin, but they're not a landlord-friendly market necessarily, right? Because you've got so much construction going on, so much development, a lot of spec that your tenants, they'll get picked off. And the cost of replacing a tenant is exorbitantly more than it is keeping a current tenant that you like. And so you always want to just blend and extend the current term, unless there's some outside reason you want to kind of move on from that user. It's always going to be a more economical decision.
You can't just say like Atlanta as a whole, right? Like you were saying, because that's incredible. The higher percentages like you're talking about that are current right now, right?
Yeah, I mean,
in some submarkets.
Yeah, these secondary markets, they typically don't have any geophysical barriers, right? So Kansas City is a really good example. It's a good city, but to drive from the airport to the part of town that we invest in, which is the South Johnson County area, it's about a 45-minute drive on a good day. So, like any place that you live, the difference between 10, 15, 20, 30 minutes away, it's a completely different neighborhood, a completely different dynamic. And so the high level MSA data has to make sense, but you really got to jump into what that submarket data tells you, because that's what's going to dictate how well the asset performs or not.
So, you were talking earlier too, just about like the matrix to, find the markets that you're looking at, and that, you're analyzing these 10 or 12 and tracking that data. Could you elaborate on just the method of doing that? Do you all just have an Excel sheet and you have somebody that like, okay, every month they're looking at this data and pulling it from specific places, or kind of what's your process of doing that?
Yeah. So we actually do have an Excel that one of our colleagues or one of my associates keeps current. And we think month to month data is too volatile. So we look at things typically on a quarterly basis and we readjust, but we start from MSAs, or that's the fancy word for cities, right? Markets that have above 1 million people within the kind of general metro area, but that aren't in the top 10 gateway markets. So a top 10 gateway market would be like Chicago, Seattle, New York, LA, Houston, big cities. So we look at that kind of, 11 to 50 type metro sized area. And then we look at, did it experience over the last, call it 5 years, pretty consistent wage, population, and job growth? And then we look at, okay, well, what are the underlying economic drivers there? Is it very tied to the energy sector? Is it very tied to financial markets, right? So, Oklahoma City checks a lot of boxes for us, but we can never get comfortable with the fact that it's so closely tied to energy. And same with Houston, even though it's a big city. We just didn't want to take on that kind of risk, but because those are oftentimes very volatile markets depending on the price of oil. So we like to see a diverse economic base, and usually that means EDS, it's called EDS and MEDS, right? So education, healthcare, government, and some kind of learning or knowledge environment, economy. So tech, for the most part, I guess would be the proxy. Those are the things that we like to see. We love cities that are also capitals and cities that are in close approximation to a large university, especially if they have a medical center attached to it. Those are the things that we like to see because we think they're counter-cyclical and very resilient. So if the MSA checks all those boxes, we look at generally where cap rates are. If cap rates are below a 7% on average for Class A office, we're probably not going to be able to afford to go there, because unless I take on a ton of debt or a ton of risk, I can't solve for that 8% yield, which I'm trying to hit. If cap rates are, reasonable, then we look at price per square foot. So we like to be around $150 a square foot on purchase price. New construction typically for surface parking is $325, $350 a square foot. If it checks the per square foot number, we look to cost on a replacement rent basis. So if Class A rents are in the mid to high 20s, that's a good sign for us, because to justify new construction on a speculative basis, considering where construction costs are, you probably need to be 35 to high 30s a square foot rent. So if Class A rents are 20 to 25, I feel very well protected. There's a big gap there between where the market is and where the market needs to be for some developer to come in, throw up 250,000 square foot spec and steal my tenants. If it hits that metric, then we look on the submarket basis. We typically will only go to 2 submarkets per MSA. And these are submarkets. This is a fancy word for neighborhood. And so we like to see neighborhoods that never experience more than 12% plus vacancy during the downturn. They have no new construction, speculative, maybe some corporate relocations or a build to suit. And we like to see, rents increasingly ticking up, call it, with inflation over the last 10 years. And so if the submarket data checks the boxes, and then we go into a price point where we like to transact between 10 to 20 million is our sweet spot. And so if there's deal flow there in that 10 to $20 million price range, that's when we will green light and start canvassing the market for opportunities. And so it's very much a top-down analysis, and only allows us, I think it's good for the most part because it takes a ton of effort on the front end. But once you get all the way down to that submarket data, you can really look at a smaller opportunity set and really dig in. And then you can build a portfolio of these 10 to $20 million deals and eventually get to scale within that submarket.
Nice. Well, we just have a few minutes left, Brian, but I wanted you to also elaborate just on your thoughts of the market, say over the next 6 months, a year, just or even further, what you see or expect, as you're looking at properties to purchase now.
Yeah, I mean, it's August 4th today. So what I say today will probably change tomorrow. So take everything I say with a grain of salt. But, honestly, it's a pretty wild time to be a market participant. The NASDAQ hit an all-time high yesterday. The big tech trend is real, and it's increasingly taking over the world. But there's certainly a huge dislocation between what you're seeing in the stock market and what you're seeing in the economy today. The economy is going to face some real pain points over the next 6+ months. And because the Fed and Congress have pumped all this liquidity into the market, that money needs to go somewhere. And so it's gravitating towards the stock market because it's the lowest cost in terms of friction to put money to work immediately. I think one of the things to really pay attention to is, if you're holding on to cash, like a lot of us are, you're looking to deploy that money, the market is expensive and there's a lot of volatility, and heading into the election, I only expect more volatility. Mm-hmm. Fixed income is just brutal right now. Yields are terrible. I personally think rates are going to go negative. And you have to understand that even though it doesn't necessarily, you don't hear about it, and you may not feel it immediately, inflation is real. And inflation is a tax on your dollars. So if you're holding on to cash or you have it into a money market account, which is giving you nothing, and I'm biased, but if you take a step back and think, okay, what should I do with my capital from an allocation standpoint? Long duration real assets that have some kind of inflation hedge. In other words, an operator or somebody can actively push pricing, I think is still one of the best places on a risk adjusted basis to put money to work. I do see inflation coming down the road. I think yields are going to go negative. I think the market will continue to kind of chug along, but there'll be some volatility heading into the fall. And there's a lot going on leading up to the election. I don't think Congress is going to get their act together to put together a CARES Act 2.0 or another PPP group. Nobody wants to take on that political liability heading into the election. They're about to break up and go on their summer break, which is, I think, pretty pathetic that the European Union and Brussels, which is just a bureaucratic mess, that they can get their act together, but that we can't. It's become this political football with people's lives in danger. It's disappointing to say the least, but it's a political reality that we have to deal with. So that's my view on the world. I think people are underestimating the ability for Congress to enact legislation that would impact big tech's business models. And so I don't know how much more runway is left there. But again, one of the beautiful things about real estate is there's no score sheet, there's no scoreboard every day. And so you've got to hold it long term. And if you take a look back and see, what asset classes have performed best over the last 100 years, it's hard to beat real estate.
No doubt about it. I love that explanation and grateful for that. Brian, do you want to share with us, how you like to give back again? And then, obviously that'll be all we'll have time for. Yeah.
So on a company level, we have partnered with a local food bank in Nashville to help, in Nashville specifically, we had a bunch of issues in terms of tornadoes that hit pre-COVID. And now obviously we're, in the middle of this pandemic. And so I think eliminating hunger or addressing hunger is something that we can all get behind, and it's not controversial. And so there's a local nonprofit that we partner with. Unfortunately, we can't do a lot physically right now because of social distancing. So we've been doing food drives or just donating, and we'll continue to do so. And then personally, I'm on the board of a group in Nashville that is a swim and dive program for children and adults with special needs and developmental delays. And so again, hard to manage that coaching process right now with social distancing, but there's still a lot that we can do in terms of fundraising, et cetera. And so those are the two things that I'm passionate about.
Nice. Well, grateful for you sharing that again, Brian, and giving back in that way. And you've just been an amazing guest and extremely knowledgeable in this space and experience. So thanks again for, just being a great guest. And how can listeners get in touch with you and learn more about you?
Yeah, I'm very active on LinkedIn. So you can look me up, Brian C. Adams or Excelsior Capital. If you message me, I'm happy to set up a call or help any way that I can. I will respond to you. And then the website, excelsiorgp.com is how you can, if you want to learn more about our investment opportunities, get on the distribution list, et cetera, happy to go from there. So those are the two best ways to get in touch with me.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com. for free material and videos to further your success.